All right. Morning, everybody. We talk about real world assets. How cool is that? And the quote just a minute ago was like $17 billion. We hear bigger numbers than that even. So we're going to demystify some of that here today. So quick round of intros. Who's on the stage? My name is Rob Massey. I am a tax partner at Deloitte. I lead our tax practice in all things crypto. We've been doing this for 13 years, serving in different crypto projects, many of you in the room, covering all things tax, accounting, consulting. We do build stuff as well. There's 2,000 of us in the firm that focus in this space, so great times. And I'm really excited to spend time with this panel to demystify what's happening with real world assets. Ed.
Yeah, hi, I'm Ed Nwakari. Can you hear me well?
Yes.
I am the founder and CEO of Red Swan CRE. We are a full-service commercial real estate platform that tokenizes real estate into digital securities. So we're licensed with the SEC, and we've been doing this since 2018.
Yeah, that's awesome. Thanks, Ed. Chase.
Hi, I'm Chase Merlin. I lead product at Braille. We're a stablecoin issuance and orchestration platform. So we help businesses create their own stablecoins and then provide a unified payment rail for sending money around the world.
Hi, Eli Cohen. I'm the general counsel at Centrifuge. Centrifuge is an open source tokenization platform for tokenizing a series of different capital markets, instruments, funds, shares, and asset-backed securities, other types of security token instruments.
So Ed, to that last point, right, we hear a range of how much the tokenized real world asset market is going to be. We hear billions, we hear trillions. How do we get their head around that? What are the drivers? What is fueling that size?
Good question. You know, in 2018, I think till 2022, there was no really need for putting things on the blockchain because financing was pretty easy. I mean, debt was pretty inexpensive, and people were buying at very good prices. But today, you're seeing high interest rates, and you're seeing debt and capital being very difficult to obtain. So we're seeing a lot of requests from owners to recapitalize the equity in their properties because they can't get loans from banks. In the next 18 months, about $1.8 trillion of mortgages are coming due. They're maturing, and you're going to see a pretty big gap between what banks are going to finance these new mortgages for to be more conservative than before. And that gives a very good opportunity now for us to go in and provide liquidity for those owners so they can actually recapitalize their assets without having to sell them off. So we think that in the future, owners will not be selling their properties because good properties are so hard to find. And so therefore recapitalizing the equity of your property is a much better situation than selling it off and losing that cash flow altogether. So I see in our pipeline about $9 billion worth of real estate. We hope to get to $25 billion in the next 2 years because all the traffic coming in is overwhelming, actually. But we're actually taking, from the top down instead of the down up approach, and we think that's actually makes a big difference for us in order to have sizable deals coming through. And there's a lot of buyers as well. People say, where's the liquidity come from? There's a lot of international buyers chasing after high quality U.S. assets, and we're just kind of connecting the dots.
Love it. Now, you went straight into one specific industry sector, real estate being massive, and you referenced something that I think a lot of times gets lost in this, and that's bringing the mortgage element as well. Some people think that you can't actually get to tokenized real estate unless you handle the mortgage element as well and put some on the blockchain. Thoughts on that?
No, you can tokenize the equity side. Let's say a property like this has mortgage debt on it that's going to last for another 5 or 7 years, and that mortgage is at 4%. We're not going to touch recapitalizing that because that's good debt. It's the equity that's usually very expensive. So if we can focus on the equity and capitalize that and maybe sell the equity at 7.5%, 8%, we're still much cheaper than some of the private corporate credit you're seeing out there that may be 12, 13, 14%. Okay. So that's very attractive.
Love it. Thank you. Eli, you want to add in?
Yeah, I mean, I think what we see, and we work mostly with tokenized public securities markets. So what we found is that the killer app in the RWA markets has been treasuries, T-bills, short-term treasuries. So not what one would have necessarily expected when we started this back in 2019, 2020, but that market has gone in about a year from maybe 30, 40 million to almost $1 billion. So there's probably something north of $1 billion in tokenized treasuries on the market already. And when you've got players like BlackRock jumping into the space, And we work with Janice Henderson. You've got big asset managers who are committed to being in the tokenized space in the funds industry. I think every asset manager we talked to in the past year has wanted to get in. So the conversations with those asset managers 2 years ago were, why would we do this? And now they're, how do we do this? And when do we do this? And how, it's become inevitable. They see the momentum, they see BlackRock in the space, they can't fall behind, so they've got to jump in.
And to your point, like it's not just treasuries, it seems to be an expansive view, all financial products. Really, don't we have a point of view that there are elements of value to tokenizing everything there? Tightening up the efficiency, bringing transparency to the terms.
That's right. I mean, I think in the fund space, the treasuries were kind of the first product, the most obvious product, but everybody's building something else. Everybody wants to know what's the next big thing after the tokenized treasuries. We're working on the next big thing, and we hope we're right with ours, but we'll see. Everybody's got their own ideas, and the space is probably big enough that there's going to be more than one winner.
100%.
I mean, the treasuries are definitely what's in popular right now because they're already liquid. I mean, you buy a U.S. Treasury, you can get out pretty easily. But you're seeing 4.5% so much on the treasuries. But eventually, people are going to see the benefit of real estate because it actually provides a much higher yield, twice the amount of treasuries, if not 3 times the amount. And you think about when you're buying in today, you're buying a trifecta of benefits when you're buying digitized real estate. Number one, you're getting a high yield, 7, 8, 9%. Number two, you're buying in at a price point that's much lower than what you're buying yesterday because the cap rate is much higher. Yeah. And then number three, you have this liquidity effect. So when you combine liquidity of a treasury to a higher yield of a real estate, you have a much better asset class. I think once people start realizing that, they're going to start putting more money into real estate securities 100%. Instead of treasuries. Yeah.
100%. Chase, we were talking about, like, none of this happens effectively without stables, right? I know this is an area you're passionate about. Why don't you layer in to talk about that dynamic and how it influences the pace of innovation?
Yeah. So I think if we think about stables as being one of the largest drivers of real-world asset growth, at least to this point, there's a number of tailwinds now for stable coins that are all coming together, and that's why we see the growth rates. I think on the previous panel, they referenced the annual volume being beyond Visa and all these kind of like eye-popping metrics. I mean, one is, we now have networks that are very low fee, high throughput, things like Hedera that just weren't possible a few years ago. We now have basically stablecoin enabled FIs throughout the world. And then when you layer on the regulatory environment, it's really now possible to send money instantly across the world. We're seeing in a number of these corridors, literally 2 to 5 minutes, US to Brazil, US to Argentina, a number of these cases. And that's why we see the growth today. And if we look at both on the business side, if we go from 100 basis points down to 20 basis points, and also for consumers, we're getting to a point where, it's really wild to think of like 5 to 6% remittance payments historically, and we're now looking at less than 1% in many cases. And so I think the first session also talked about kind of the excitement of being like a US-based company, which wasn't, it always felt like a kind of a weight in previous years, but I think it's a really exciting time now.
And are we to the point where we're gaining confidence in the throughput, like we can handle the volume? Is the tech there?
Yeah, I think I sort of think of this model. So like in the beginning when we tried to move payments on chain, people would use Bitcoin or these volatile assets, and obviously that's challenging. Then we got stable coins. We have a lot of stable coins today. There's more. Now we have, again, very high throughput, low fee networks. Things like Hedera also have fixed fees, which are very, very predictable, easy to use. And so we really have the primitives in place. Maybe privacy as being like one of the remaining ones. And we see it at scale already today. I think we really have the infrastructure. We have the wallet infrastructure as well. And so that's just not something I would say like even 12 months ago was the case.
Yeah. Awesome. Well, you mentioned FX. I know this is a big topic, right? People are like, okay, game on, right? It's not just here, but it's around the world. People really tokenizing currencies and what that does to the FX and the efficiencies running through the different business models. And being the tax guy in the room, I have to remind everybody, like when you create stables of different currencies, it's still not money by most measures. And so some of the rules we've grown up with, the tax rules and safe harbors, they may not apply yet. So more to come on that topic. Just dropping some caution flags. Eli, I know you've got a lot to say on a regulatory front, and Chase kind of opened up that can. Do you have thoughts on what's the state of the regulatory evolution, what's impacted, what should we expect next?
Yeah, I mean, obviously everybody's very focused on the U.S., but there's things happening all over the world as well. The MiCA rollout in Europe is something to watch, especially on the stablecoin side, and the split between the regulated stablecoins with the European exchange and the unregulated stablecoins that are going to be banned or are in the process of being banned by the European exchanges. But here in the U.S., we're all very happy to see the crazy hostility of the Gensler regime gone, and the dropping of those cases against Coinbase and all the other kind of exchanges that they've gone after. There's probably going to be still more of that to come, of course. But I think actually it's going to be in the RWA space that we're going to see the earliest and most impactful changes in the regulatory space. We've already seen a number of them. They've already lifted the rules about custody for the banks, for crypto assets. We saw last week that the SEC approved the figure market stablecoin YLDS, which was something that's been pending since 2023. We know there's a stablecoin bill coming that on both houses have bills already there, and it looks like those are going to get bipartisan support. So we're going to have a stablecoin regime in the U.S. sooner rather than later, and the way that looks and how that looks versus the MiCA regime is going to be very, very important for the RWA markets, and certainly something to keep an eye on. The other parts of the market, I think it's going to take a lot longer for the SEC to put things in place, a lot longer than people think, to put a full regulatory regime in place for like special purpose broker dealers and things like that Commissioner Peirce is talking about. But we'll see a lot of change this year, and probably more next year when things begin to be implemented.
Yep. Yeah, go ahead, Ed.
I just want to tap on that because there's a misconception that there's a lot of regulatory constraints, and yes, there is for cryptocurrencies, and maybe for other digital assets, but when you are talking about real world security assets, things that are generating income, like real estate, for example, there's been a solid framework from SEC since 1934. I mean, we're licensed broker-dealers with FINRA and the SEC, so there's a framework already established. I just think there's a misconception. When people hear blockchain, they think automatically cryptocurrency. They don't think about digital securities.
Yep.
Matter of fact, even the security broker-dealers don't know much about digital securities. But there is already a framework that works in place. I mean, KYC of investors, US investors have to be accredited. Outside investors are Reg S. They have to go through a KYC process. I mean, so all that is already in place. We're just now taking advantage of it.
Yep, 100%. Eli, you said something I want to come back to. When we look at the stablecoin bills, I saw a Venn diagram the other day of the two stable bills out there, and there's a lot in the middle. There's a lot of overlap, not a lot that doesn't fit in, which is pretty interesting. So this may happen soon, right?
And even it's likely to get bipartisan support. You've even seen Maxine Waters come out and say that she's in favor of pushing it forward.
Yeah.
So the stablecoin bill is not something that's going to be that controversial, and it's going to get bipartisan support. It's really low-hanging fruit for the administration. So I'm sure that it's going to go forward pretty quickly.
Yeah, really exciting to see just on the come out party on both. It was like there was alignment, which was fascinating, right? Telling of where things probably have been.
Yeah.
We just needed the voice to get them to the table.
That's right.
Which is awesome. On the regulatory front, I will say, just to chime in again, being the tax cloud in the room, when we talk about tokenizing real world assets, there's a concept that says what you did is just tokenize the same thing. But there's also a concept that says if you changed the nature of what you tokenized enough, it may not be a digital representation of the same thing that you tokenized. So there's a really big question out there when we're designing these products, and probably a pause button we all need to hit before we go too far. There's been a little bit of instruction. It actually came through a tiny bit of guidance on retirement accounts and the concept of a collectible. When the IRS started commenting on the looking through that which you tokenized is what is still underneath. If it's the same thing you still had, maybe it's just a digital representation thereof. But if you change it, if you brought new utility to the issuer or the holder, you may not have where you started with, including equity, right? We've seen this where people tokenize equity and you've given it enough utility at the holder level, you've given it more than it had, it may not be equity from a tax perspective. So that really
Yeah.
blows up things quickly. So again, I encourage everybody to pause before we go too far on that.
That's right. Yeah, tax is going to be very important.
Equity.
You are tokenizing equity, but cognizant of this point, right? Don't change it. Yeah.
Yeah, we're not changing it at all. I mean, I think what you're talking about is when you create a derivative of
Correct.
equity, but you really, when you're tokenizing a building, you're buying the equity of the SPV that owns that building.
That's right.
That property. So you're just taking the same paper share that you once owned, and
Yep.
now you have a digital share
Correct.
in your wallet.
But inherently what happens is the business people, oh, but we can do this, and it's and slice and dice, and it can do all these things, and all of a sudden you're left with something that's a little less equity-like.
Yeah.
So
We
gotta
don't do
watch
that at Redsmond, but that is possible. To be
These
done,
are the
yeah.
ideas that come around.
Yeah. It's
You're
also-
going to chime in.
It's also a point that, you know, I think everybody's very much more bullish on the U.S. market than we have been in the past 4 years, but the tax issues are still going to remain. Even if the SEC is very positive,
Yep.
the tax issues will still remain, and even if you do a retail offering in the U.S., it's not going to be that attractive to retail outside the U.S. because not everyone's going to want to submit their W-8 bends, you know, to the issuer. There's still going to be tax obligations and tax forms to
That's right.
submit, which will make it a little bit less attractive for the outside of the United States.
More collaboration needed, I think. Yeah. Chase, where else in the ecosystem do you see stablecoins impacting? Right, we're watching it hit maybe the products. Do you see it in asset management? Do you see it in retail? Where do you see the next evolution of this? You know, what's probably the best use case today of the tokenized assets?
Yeah, from what we're seeing today, I mean, pretty much any money flow that has some international component
Yep.
can be improved with stablecoins somewhere in the flow. And so if you think about, you know, business payments, supplier payments, import-export, repatriating funds, consumer remittances,
Yeah.
all of these have usually opportunities for stablecoins. You know, if we think about traditionally, right, going through SWIFT or going through things like netting, these work, but they're very complicated. If you think about the system of setting up liquidity in all of these countries and things like WISE, which have been, you know, the primary solution today. You know, by essentially we have a lot of people call us now like the stablecoin sandwich. We could basically layer local payment methods with stablecoins in between, and we get you know, most of these jurisdictions now have very good local payment rails that are real time. Stablecoins now allow you, right, to move value at the speed of the internet, and we can get these incredible cost reductions. And what's exciting to me is that, you know, this touches people's daily lives with these flows, and the cost savings are not just incremental in many of these cases, but they actually can be transformational to these business models.
I love that. I love that. Yeah, cross-border for sure. And so, you know, you know, with the U.S., maybe going back to your point, Eli, with the U.S. really starting to lead a little more visibly, then the rest of the world feels like, okay, it's time, right? Any other areas of the ecosystem you're seeing favorite use cases come around that you're really looking forward to in this next era?
Yeah, I mean, we work in the funds management business with the asset managers, and we see that the whole ecosystem that you can put in place to create sort of a seamless fund share, tokenized version of a fund share is really, really valuable. I mean, the transparency that you can put in, the real-time NAV calculations that you can do with oracles, you can tokenize almost anything as the underlying asset and create an issue fund share which is bespoke for a particular group of investors. Everybody we talk to is super excited and thinks that, you know, this is absolutely going to be the wave of the future.
Love that. Yeah, for sure in asset management. Love that. Go ahead, Ed.
We see a tremendous opportunity right now for an arbitrage between international investors and U.S. property owners. If you think about it, many countries right now that are in a different economic situation than the U.S. can borrow at interest rates at 1%. And then they can turn around and take that capital to U.S. and buy assets and invest for 7.5%, 8%, 9%. So it's a great arbitrage, and you're seeing a lot of demand for U.S. assets that are income producing, and they also know that they're, like I said, buying in at a lower value. So even, you know, they have capital gains, but really the core focus of them doing this is to get that cash flow. So even think about, you know, crypto whales who own Bitcoin. When Bitcoin's at 105 and you borrow against it, and let's say your borrowing cost is at 5%, for example, and you buy into equity in real estate that's paying you 9.5%, you've already locked in your 105 thousand value in your Bitcoin, and you just locked in real estate at that same value. So that's a great arbitrage for people to get involved and start balancing out your portfolio of assets, because to have all your assets in one basket, as you know, as a CPA, is not a good advice. You want to diversify, and I think you diversifying from Bitcoin or cryptocurrency into RWA real estate or other income-producing assets, data centers, makes a lot of sense.
Yeah, people lending against collateralizing the unrealized gains they have in crypto, as an example. This is happening today, right? We're seeing that across the platforms. That's fueling a lot of activity.
That's very true. But when you collateralize against crypto, you take the chance of the volatility.
That's right.
When you collateralize against real estate, you don't have that volatility. I think it's a much, we've been financing real estate with mortgages for hundreds and hundreds of years, so there's no doubt that that's a good place to
going both ways.
DeFi.
Yeah, and we are seeing that for that reason, people looking at real estate and crypto sort of in the same conversation.
Yes.
We're out of time, guys. This is awesome. Thank you for the